Pete and I are going to do a zero DTE piece. You ready?
Yeah, let's fire away.
Since you've done a zero DTE piece. Stop losses and defined risk zero DTEs. I did not do a zero DTE trade today. I did one yesterday. And I did one yesterday, about 8, what time do we do it? About 8:45 in the morning. And by 9:15, I had my 25%.
You were done.
I was done. But I find, and by the afternoon, it was a $5 loser.
Right.
So I can't stress this anymore. If you're going to trade zero DTEs, take your profits early and get out.
Right.
That's it.
Yeah.
And then you come back the next day. Let's go to the first slide, John. Stop losses in zero DTE, defined risk. So the zero DTE markets in the most popular underlyings, which is really the S&Ps, are extremely active and liquid. Unfortunately, BPR realities mean that trading in them is largely restricted to defined risk positions. Right. I actually did an iron condor yesterday, defined risk position. Last week, we examined the effects of iron condor initial trade parameters, the short strikes, the win width, and everything else, and closing winners at 25% of max profit, which is what I did yesterday. The extreme liquidity of zero DTE options allows active traders to practice almost any mechanics they want. Today, we'll examine the effects of defensively closing losing positions.
I think this is really interesting because you've got this great opportunity with massive theta decay, but you're also taking on gamma risk. So it brings in the question, this piece is really interesting because it talks about, okay, how do I tame the beast? How do I make sure, coming from the world of futures and spot FX, they're Delta 1 products, they're static delta.
Yeah.
Management's an important component in that. Here we have the same exercise we're going to talk through right now where we talk about how do we harvest winners and how do we manage, what is the sweet spot around management as gamma starts to take hold on these.
Absolutely. And you know what's for people that are confused by what the thing popular underlyings here, most people who trade zero DTEs, some people trade NASDAQ, so the Qs and NDX and NQ and that kind of, but most people, I would say 90+% of the business in the zeros is in SPX,
right,
SPY, ES. There's a little bit in XSP. There's a little bit in MES, but those are a little less liquid. And the majority of the business comes from defined risk spreads or long positions in SPX, ES, and SPY. The advantage of SPX is that it's cash settled.
Right. And don't you think it's also the liquidity? You want, especially for a fast-moving trade like this,
there's massive liquidity in all these.
Right. But you want to be able to get at that price quickly.
Right. Yeah. But the advantage of the SPX is that it's cash settled. ES settles to futures.
Right.
And SPY settles to stock.
Right.
So that's why most people kind of lean on the SPX.
Okay.
And if you're wondering why the ES can't settle to cash because it makes the most sense, or why the stocks can't settle to cash SPY, it's because it's a regulatory reason.
Right.
It's not because they don't want to.
No, it's something
they can't.
We've battled long and hard over.
Yes, we've battled this thing.
Yes.
Trust me. Let's go to the next slide. So we did a study. We used 2 years of data in the zero DTE SPX options. We sold iron condors at the market opening with 20 delta short strikes and wings at 20 past. Trades were closed when they reached 25% of max profit. We repeated the study using $40 and $60 wide wings, so really wide wings, and filled everything at mid-price, which is a little misleading, but close enough. You can take off a dime if you want. And let's go to the next slide. So there's a couple things. Now, remember, this is a stop loss discussion. And the stop loss that we talk about is...
It's not something we often talk about.
It's a mental thing.
Right.
Okay, where do you stop yourself out?
Right.
So with iron condors with $20 wide wings, all right, if you notice here, the average P&L, if you take profits at 25%, these are not times 100 or whatever. These are just the profits. $10, $11, $12, $11, $3, and $24. These are with, everything from the losses being unmanaged to the losses to taking a stop loss. The C-bar is obviously lower if you take a stop loss, which the one thing I wanted to point out here is that the win percentage with stop losses is a little bit lower. The other numbers don't change that much. And this is just the first slide. This is $20. This is 20 delta short strike, $20 wide wings.
Now, CVAR is that estimation of the
Worst loss.
worst loss, 5%. So 1 out of 20, what your worst loss will be.
Yes. And it's all those worst losses are factored into these numbers.
Right.
That's why the number is only $10. Like your normal trade, like I think yesterday I sold a trade for, I want to say $1.50 or $1.60, I don't remember. And I bought it in for $1.10. So I made 40 cents, which was 25%. Like, so if you're doing, if you're doing a one lot, it's $40.
Right.
And so the numbers tend to be like about probably 4 times these, but then you have to factor in the few losers that
Right.
wipe out some of the winners. Okay. But just so you see, so this is with $20 wide wings, and this is with your stop losses across the board. If you push your stop losses out further, you give yourself a much higher win rate. And that's the takeaway from this slide.
Right.
Let's go to the next slide. So with $40 wide wings, you can see here, the numbers are going to be very similar. The win percentages, very similar.
Yeah.
The difference here is that, you'd have let's put it this way. You have a hard time arguing that the stop losses really help you much. It's really just about the 25%. Taking profits 25%.
Right.
Because the stop losses, I don't know. I don't know. I think I'd rather have the higher win percentage.
Yeah, but if you're depending on your account size, and I mean, part of the goal every day is to make money, but part of the goal is to be able to come back the next day. You do want to be mindful of statistically what you're exposing yourself to in that 5% outcome.
I hear you, and I guess my takeaway from the first 2 slides, and John, you can go to the next slide, is that if you push your stop loss way away, your win percentage is so much higher. And this is $60 wide wings. It's the same story. And
absolutely, if you're going to 200 or 300%, that doesn't make any sense. You might as well just let it go.
By not using stop losses here, which is our general approach, we don't use stop loss. We take a loss at some point early in the day, or we take profits.
Right.
And that seems to be the best approach, because the argument here is if you use a stop loss, you don't really make that much money.
Right.
And if you don't use a stop loss, or you put it 100, 200, 300% away, you do actually better.
Right. Right. And you're saying a stop loss, the traditional, keeping it tight, 25, 50%.
You can't do it.
No.
Yeah,
Here, and it's great to see the numbers kind of reinforce the concept that at 100%, that lands in that sweet spot.
Yeah, 100%, 200%, 300%, or not at all, way better and a much higher win percentage.
Right.
A higher win percentage, and you make more money without using a stop loss.
Right.
I hate stop losses anyway. This just goes to validate everything. Let's go to the last slide. So the zero DTE option markets provide active traders with an opportunity to quickly and efficiently manage their positions. And so far, quickly taking profits has proven the key to success. I have found that 100% of the time. Stop losses, whether they're automated or through alternative active trading, which just means attentive active trading, which means just watching them, are not guarantees. In a fast-moving market, they can result in losses larger than their intended levels. But even only checking once every 10 minutes, defending these losers quickly was effective at curtailing the worst losses at the expense of giving up the frequency of winning trades. Large stop loss limits, however, generally performed worse than letting losers ride. If you are comfortable with exposure to occasional large losers, then it may be best to stick with only closing winners. I feel like
would you go with tighter wings? If you were concerned about that CVAR number, would you go with tighter wings to limit that and just let them go?
It really depends how much capital you have.
Yeah.
It's all based on the amount of capital you have.
Right.
Everything's based on how much capital you have and how much you can use.